Good evening. This is Ruby with MRB Financial. Thank you so much for joining us today for our topic of the week. For today's topic, we will talk insurance policies. Right now, it's a big deal with everything that we have going on. I'm certain that many of us have thought about getting additional life insurance. So we thought to make this video so that you could go ahead and make some of those decisions. We hope that you see value in today's message. As always, please don't forget to share this message with anyone that you think it will help them out at your convenience. So yeah, let's get on with our topic of the week. Um, for life insurance, let's talk about all the different types of policies and coverages. Um, when it comes down to it, if you're starting the process of shopping for life insurance, you may be feeling, a little bit overwhelmed, thinking about your priorities, and maybe it'll set you back, maybe it won't. All the different factors to consider for shopping a life insurance product, and what is best for you. So these are the big questions that we're going to answer today. So yeah, stay tuned for this. To start, let's discuss the major types of life insurance, which you will see them split as either a term policy product or a permanent policy product. The easiest way to see it, as I explain everything, think of it as you're renting the house or you're buying the house. Same thing with the life insurance. Either you're renting the money or you're buying the money. So when it comes down to a term life insurance policy, um, the insurance policies provide basically affordable coverage for specific death benefit over a predetermined period, such as 10, 15, 20, or 30 years. It will be, a smart choice for a lot of or certain customers like parents who want to ensure their children's future is provided for until they reach adulthood. That is very common, for you to make sure that, your priorities are served, such as, paying for education, making sure that they're taken care of financially. Those are, some of the folks that would benefit from having a term life insurance, as you get to, rent more money. But, the thing is, it does lose its value after the policy term. So if you bought it for 30 years, then that policy will go away. You cannot keep that policy because you said you only needed it for 30 years. But prior to expiring, instead of starting all over again from scratch, what many life insurance companies do is they offer the option to convert a term life policy to a permanent one, such as a whole life or universal life policy. The cost in terms of these options vary from company and policy type. They are definitely worth discussing with your financial advisor before purchasing a whole new life policy or a term life policy. Um, as far as the permanent life insurance, there are different options as far as the permanent. A category of coverage that includes whole life and universal. These types of life insurance are more expensive than the term, but they offer more benefits. Like we said, the term policy, after the period that you bought it for, it would expire after that. That's why it's cheaper, because you're renting the money. Versus a whole life or a universal policy, you are buying the money. So let's talk about how it does that work. How are you buying money with money? Permanent life insurance company policies, they accumulate cash value over a certain period, or over a period, I guess. With a policy that accumulates cash value, a portion of your premiums grow tax deferred. This is very important for anybody that's worried about paying too many taxes. The money that the Cash value that grows. This is tax deferred, meaning that you pay taxes later when you take it out, not now. Some companies offer different investment options to help with the cash value to grow faster. This approach often carries, other financial risk because they did add an investing vehicle into the policy. The advantages of the cash value are that you can take out loans out of the policy or make partial withdrawals against your policy, and you may be able to use the cash premiums also to cover the premiums, not the cash premiums, I'm sorry, the cash value to cover the premiums. However, these options will reduce or can reduce the benefit if you die before you pay back the loan. Um, a policy with a cash value generally will cost more for the same coverage than a policy without a cash value. But if you plan on taking advantage of those benefits, it may be worth the extra expense. So think of, you're just taking a loan out of your policy. The whole life insurance. Let's get into, so we just talked about that was a permanent benefit values to permanent life. Now we get into the whole life policy. It is permitted to also take out those loans that we were talking about, but check with the insurance company. This is an option. This policy type may be eligible for dividends as well from a mutual company, and it is typically expensive. It is both predictable and flexible. So because of that, it can be a little bit confusing. What do you mean it can be predictable and flexible? Some life policies will specify how long you will have to pay your premium. And then with some policies, you pay the premium until you die. And with others, you pay for a specific period, either a number of installments or until a certain age. Some whole life insurance policies will even insure you for a life after you make a single payment, which is, let's say you got an inheritance and you wanted to, make sure that you can keep this money in a safe vehicle. Let's say that your mom left you some money for your kids' education and you don't want to waste that money. A good thing that you could do is buy that whole life policy uh, so that you could park the money into that policy, add some riders to it, do some, talk to a financial advisor about the different things that you can do with it. And then you don't have to pay anything. And, by the time you see the policy again, you should have seen some increments in that policy while you protected, the money, the inheritance that was given to you. So that's just an example of when you would, or, they do sell policies that if you buy them cash, they're like anything else. If you buy it cash, it's cheaper versus if you pay it month by month, it's gonna be more expensive. So look at it that way. You could buy it all in a lump sum cash, or you could pay it in monthly payments. You could pay it in quarterly payments. You could pay it once a year, depending on the insurance company options. That's what they mean about a lump sum. So that's a whole life insurance. Now we're gonna get into the next one is the universal life insurance. This is also a permanent vehicle. Universal life is a permanent coverage that builds cash value as well with an investment option. So think of what we just said on the whole life permanent life insurance. Picture that, and then add an investment vehicle to it. So think, let's say an IRA. You could put that inside the vehicle. So it's like a whole life policy, but now you just added an IRA into it. It is frequently offered with flexible premiums, although those premiums do affect the cash value and the death benefit. Because of all the different options that it entails, universal life is more complicated than the other life insurance. And it's really only suitable for those who are comfortable with the complex financial investments. But really what you gotta understand is the very first thing that I just said about how I introduced it, that it's just like a whole life policy. So if you could think that it's permanent, you get to, leave money, you're buying a house, but now the universal, you have an investment vehicle in it. So think of it like a three-step process. So if you could follow that complexity, let's keep talking about it to see if this is maybe an option for you. Uh, the universal life insurance also offers two different types of, or two options to the universal life. The Vario Universal Life is a type of universal policy that ties cash value to a number of investment options. Indexed Universal Life is a universal life policy that accumulates cash value based on the performance of certain indices. It is typically less expensive and less risky than a variable universal life because there is no actual investment in an index. And then the other policies is no exam life insurance. With this type of policy, you don't have to take a medical exam during the application process, although you may still need to answer some questions about your health and provide medical records. And, according to the insurance company, they may also ask some personal questions. This may be a good option if you have any health problems that could disqualify you from obtaining a traditional life insurance policy. And then the last thing that life insurance policy carries is riders. This is considered a feature. A rider is a provision of an insurance policy that it usually adds benefits, although some add restrictions. So just look at if you're going to add a rider, if there are any restrictions to it. They do help to customize your coverage according to your needs. They do add a cost to the policy. Think of the rider like you went to McDonald's and you went to buy a burger. And when you buy the burger, it comes with, just the cheese and the meat. The riders are going to be your lettuce, it's going to be your ketchup, all of that. But you pay extra for those things, okay? So think of all the extra things that you got to pay. That's what a rider is. It doesn't automatically come with the policy. I know that was off, but I think that was the easiest way that I could explain what a rider was. So it is an added cost to the policy. So for example, a rider is an accelerated death benefit, which it enables the policyholder to the death benefit while still living if he or she were to be diagnosed with a terminal illness. Some riders may be added at the beginning of the policy, and some other riders can be added at any point. So just, it will be a question to ask the company that you are looking to purchase from. So let's talk about more riders so that, this could make more sense. The most common and useful riders, according to the Insurance Institute, is a disability waiver of premium rider. Under this type of rider, the insurance company will waive a premium payment for a certain period of usually 6 months. So think of it, you become disabled, you bring that paperwork to your insurance company, you're like, hey, you know what, I can't work, here's my paperwork. They would typically go ahead and say, okay, for the next 6 months, because it is a short-term disability, you don't have to pay your premium, it will be waived. And then once you go back to work and all of that, then, it'll go back on. As far as permanent, check with the insurance company to see if it's more than that, because we're going to furthermore talk about insurance shopping from a company. So that will be a question to keep on the back of your mind. Accidental death benefit rider, which the insurance company doubles the death benefit if the policyholder dies in an accident. Let's say a car accident. So let's say that you bought $1 million policy, and that's just what it is. You're gonna you need a meal to leave for the necessities. Um, if you die in a car accident, instead of 1 million, it'll be 2 million. So that's what it means by it doubles the amount. So then it's usually cheaper than to buy, $2 million. But it is a rider, and it only gets honored if you died in an accident. Another helpful rider for many people is the guaranteed insurability rider, which allows the policyholder to increase insurance benefits at a certain intervals, usually every 3 years until the age of 40. And what this means is you don't have to undergo another medical exam or otherwise demonstrating eligibility for that extra coverage. So who would use this rider? Let's say that there's diabetes in your family, and you do not have diabetes right now, you're healthy, but you don't know. You're just one of those people that's like, you know what, I think I may get it. Let me just add that rider, or, something like that. That protects you from, let's say, the next 3 years, or let's say you don't want to be taking the exam. You want to buy some more. You're going to do it before you're 40. But you don't want to put yourself through all of that underwriting process. This will be another rider that you can use to say, you know what, I do want to buy more, but not right now. But I do want to do it before the age of 40. I don't want to go through the medical exam process, so I'm going to go ahead and add that rider. Other common riders include long-term care, which is generally available with cash value policy types to access the death benefit to use for specific long-term care. Term conversion, to convert a term policy to a permanent policy. So remember that first policy that we talked about, the term life insurance? This one, I would ask, if you're looking at the term life insurance, to say, hey, can I add a rider to the policy saying that I could convert this policy into a whole life policy, or what else can I convert it to? So think of it like you're exchanging it for something else. So then you buy a rider for it, because let's say your kids are, let's say, 14, and you want to start keeping some of that money instead of renting the house. Now you're doing rent. Let's say you were doing rent to own, is how you could think of it this way. Like you were renting the house, but now you want to buy it, and you want to see what that looks like to convert it. What other riders? Waiver of premium, which covers premiums if the policyholder becomes ill or disabled. And guaranteed insurability, which lets you add the death benefit without providing more health information later. They also had children's protection, spouse protection, state protection, and lapse over a loan protection. What these last four are the children's protection, spouse, and state. Basically what that is saying, you know what, I want to insure one of these three or these three, but I don't want to have to buy them a life insurance. I don't want to go through the whole process of, getting a whole new insurance. The amounts are usually smaller, but we can't say that for every single insurance company, but I would check that with the insurance company. And you don't go, so then that allows you to buy insurance for these, your child, your spouse, or your state. That's basically what that is in the same policy. And then lapse or over loan protection, basically meaning that, like, let's say that you miss a payment for whatever reason, you have that protection. So then you could, like, let's say you miss a payment or two, you could go ahead and call them and say, hey, you know what, don't cancel my policy. Go ahead and, I want to stay active, but here's my payments. So that's basically what that last one is. And then, how do you receive benefits for all of this? The whole point of, life insurance is for, you to receive a benefit afterwards. So life insurance benefits typically are paid out in a lump sum as a default method, but many life insurance companies nowadays will offer additional options to the beneficiaries. Those who, want the full death benefit all at once may be able to choose investment accounts or installment payments over a specified period, or roll that into a new life insurance policy. So before it used to be that they just got the money and, okay, thank you for your service, I'm sorry for your loss, here you go. Where now they are, being more flexible, and they are adding more payout options to the beneficiaries. As far as a whole life policy, a permanent policy, we did talk about the benefits of, you could take loans up against these policies because this is your money. There shouldn't be any tax consequences. But if there is an investment vehicle, let's say with the universal life, we'll think of that tax that's being deferred for later. I would just check on that piece. So those are really the main benefits. You could use these to leave money to a charity. You could use to leave money to your loved ones. This was one of my favorite vehicles. To be honest with you, as you guys know, we believe in investments. We believe in, growing your family, and life insurance is one of those vehicles that many have used to bring their families onto the next, income level. This is how many people leave wealth to their families, because they buy it. It's so much cheaper to buy a life insurance than it is to save your money on your own. For, whatever you could say, you could save, you could just grab that same money and pay a life insurance. So it is a favorite. It is, we do recommend it, but this is more for your literacy. We're not trying to sell you the product. We don't offer it right now this year, but we did feel that it was an important topic for everyone to understand, especially because it is a time that many people are really considering it. So let's get on to the part of buying the life insurance. How would this look? You know, so this is going to be more of, just brainstorming for you. And, let's say you have decided, or if you decide, the first thing is for you to consider when shopping, whether you need it or not in the first place. It is primarily designed to provide financial uh, assistance for your dependents after you die, although it can be used for things such as, like I said earlier, benefiting a charity or keeping a business going. If you're if one of the key employees dies. So determine which type of life insurance is right for you. Once you have decided, out of the term life, the whole life, the universal life, and if you want some riders, once you have decided that, then you're going to need to decide how much life insurance you need. When you talk about the life insurance, you're going to need to decide which insurance company you want to go with. So before you decide which company, you're going to need to decide how much life insurance you need. So to decide how much you need, you're going to need to take into consideration the Social Security, any other investment vehicles that you already have. Let's say you have an IRA, you're going to have to pool all your money together and say, okay, according to what I have today, according to what I'm putting together, how much money am I actually going to need in life insurance? One of the things that the insurance industry has said is that most people say they never, when it comes down to them using the insurance, they've always said, I didn't buy enough. I wish I would have bought more. It's never, oh, I bought too much, you know? So think about those things when you're thinking, you know, how much you need. When you talk to a financial representative or insurance representative, they have different titles according to their designations, according to the company that they represent. You know, they will help you when you work with someone one-on-one. The benefit of working with someone one-on-one is that they help you determine how much you need. They do this all day long. They make it, you know, really simple. They'll ask you for all the documentation. They'll put a proposal for you together. That's if you work with someone. Otherwise, you're going to have to build it up yourself and then go to your, online. If you're an online shopper, you're going to have to know what that number is, what that number means to you. So to decide how much life insurance coverage you need and for how long, the Insurance Information Institute recommends considering some of these factors. What is your loved one's financial resources after you die? Once you broke down the Social Security and other retirement-related survivor benefits, other life insurance, let's say at your work, a group life insurance. A lot of people don't buy life insurance outside of their work. They think they have enough, but that's because they never actually sit down with someone. So many walk around with this conception of, I have enough life insurance, but then what happens, you leave that job and now you start all over with a new company, if they even provide it. So, you know, there are people that have their own policies outside of their job. They have their own policies to make sure that, you know, if they were to lose their job, if, you know, people that are constantly changing jobs, they have their own policies. And then, you know, once they're at their work, I feel like they treat those as their term policies, where I will buy extra once I could buy it cheaper from my employer. So if you have one of those, you're going to loop that into, you know, how much money you're going to leave behind. And then subtract the amount of resources from the correct amount of coverage. So let's say that you're like, you know what, I think I'm going to need 3 million. I think 3 million sounds right. According to my lifestyle, I'm going to need 3, you know what, but 5 would be better. I'm not sure what I have, so let me loop all my assets together. So let's say you come up that, you know what, you already have 2 million. Well, you could definitely buy the $3 million policy because you already have 5 million. You already had 2 million. So once you mash them together, you have the 5 million in total that you needed. And then we talked about the not buying enough. So then the next thing is to choose the right insurance writers. So remember how we talked about, the burger and adding the extra sides to it? That's what this is. According to your lifestyle, according to what what you think you're gonna need, think about those writers. So when you do go to the insurance company, you could ask them about these. And then the next thing is the life insurance company. This is a very, very important step. The reason for it is because a lot of people don't think about the life insurance company as a reflection of the product that they're buying. When you choose a life insurance company, although price may be the first thing that you consider, you want to buy it at a decent price, choosing the company is going to be one of the things that you're missing out on the price. So think of when you're insurance shopping, let's say a car, home or life insurance. When you're buying, all the insurance companies have their own different rates. They have their own different credit rating according to the company that they are. So sometimes just because you buy cheap from a company that doesn't have good financial backing, they may not cover your claim. When it comes down to you processing a claim, they're not going to cover your claim. Well, guess what? You're not going to be here to collect the money. Your family is. So now you're just passing on a burden to them for buying from a company that's not financially stable. So look at always look at the insurance company, how good they are. How do you see them, being in the insurance industry for the next, 3, 6, 7, 8 decades, because that's how long you're going to live, right? Or, more. Um, so it is just helpful to always know what you're getting for your money. You could do this by comparing the life insurance quotes from online brokers and talking with agents who represent multiple life insurance companies, or you could go to a standard company as well. You could, shop around between all of them and see how one company is better than the other according to your needs. And then as you compare the quotes from the competing companies, you might wonder, why do the premiums vary among the companies, even though the same amount of coverage? Let's say you bought the same policy, but you get different quotes from different people. Well, this is because there is no two insurance company policies that are exactly the same. Although they use the same names, they use the same, rules, they could make up their own policies according to how they want, as long as they're all following the same guidelines. So it'll be important for you to understand who you're buying from at the end of the day. It's like anything else. Just understand who you're buying from, because each company uses their own algorithms and they write the coverages in their own way. Um, so that's the second thing. Also is your premium might not seem to have much in relation to the amount of coverage that you receive, but it is carefully calculated by your insurance company. They calculate your premium based on statistics that show how likely they are to profit on your policy before paying out your death benefit. So these are things, the further complicating the thing, this is what also goes based off of the company's financial rating, and it is based on their liquid assets. We're going back to the financial to make sure that they have, like, how much money is available to pay out the benefit. So I think that's like, it's not that hard to understand, but you want to basically look at the company from, are they charging a lot because they don't have enough pool of clients to pay you out if something were to happen to you? Or is it this one big huge company that or is it a small company that could pay out, therefore, because they have enough clients, so therefore they could afford to pay your claim? So that's just one of the things amongst all the other things that I mentioned. And then, how important is an insurance company financial rating? 5 different independent agencies rate insurance companies based on their financial strength. So these are AM Best, Fitch Ratings, Crowe Bond Rating Agency, Moody's, and Standard & Poor's. Each of these agencies uses its own scale and criteria. The Insurance Information Institute offers advice as far as ratings. Don't accept what the insurance companies themselves say about their own ratings, because most likely they're going to want to they want to, floor you and tell you how great they are. You want to see the information that they give to you that somebody else said about them. These are the people that you want to hear that they are a good company. So now, the other thing to look at is to stay clear from companies that have bad financial ratings. About half of the company in the market are financially strong, and most others have a decent strength. So a company health matters, like we said earlier. If they're not doing good, then they might not have money to pay out your claim at some point. And then another factor is, before adding or deciding on the company, is check if there's any complaints. it's rare for insurance, life insurance, it's very rare for them to have complaints. So if they have complaints, I will look at that twice. So it's the NAIC, which you can Google. You can take a screenshot of this, copy and paste whatever you need to do, put it on your Google and look up according to the company that you are looking for. And then the other thing to look at is the company or is it a mutual versus a stock? Because there are different ownership structures, but the stock and mutual companies are by far the most common. And it might make a difference to you when shopping for life insurance. Some consumers think that a stock insurance company is a better choice because you know the responsibility to create profit for outside investors will help them ensure the company is managed well, while others prefer a mutual insurance company because they want the opportunity to earn dividends if the company performs well. So do you want stocks? Do you want dividends? So, you know, that will be the other thing of looking into the company itself. And then, you know, not all insurance companies are offered, not all life insurance companies are offered in all of the states. So some insurance company may sell some, but not all in a certain state based on those state laws and restrictions. So look at that too. If you're doing the Googling search, if you're shopping for your own, if you go to an advisor, usually they'll check that off the list for you. But if you are doing your own, there will be a thing of like, if you really like this company, are you even in their state? Do they sell in your state? That's the other thing. And then also is, do they offer discounts? Do they have innovative options? Such as, you know, some companies offer a discount for wearing a fitness tracker or meeting certain fitness goals. You know, those are the other things for you to consider. And then just, you know, looking to see if there are any truly hidden costs in a life insurance company. Life insurances are, you know, a little bit different. So I would just look to see if there are any, like let's say per se, is there a hidden fee because I'm a scuba diver? That's something I would want to know, you know. Um, so once you have decided on all of these here, now here comes the fun part, purchasing the life insurance. The policy can be purchased online, like we said, or at a agent's office, a broker's office. When you do go through this process, if you go the route of all of the other ones except for the no medical exam, you could expect to give them all of your personal information, such as, you know, where you live, you know, what's your weight, what's your family history, everything that they need to give you an insurance quote. They basically are trying to figure out, you know, what risk they're taking if, you know, they take you on as a client. So they want to know everything about you. So do expect to go through all of that process. If you buy over a certain amount according to the company, they may make you go through a medical exam. According to, they may request medical records from your doctor's office. They may request, I don't know what else. I think I covered most of it. Aside from that, they shouldn't be requesting anything else. So do expect to give them all of your personal history, all of your medical history. You know, if you're a smoker, if you're, like we said, if you're a scuba diver, they might want to know that. And you might want to know, okay, well, you know, that's something that I do love to do. That might be something that you might be willing to shop around with from agency to agency if you know you're, you know, that high risk person. And then whether you buy from online, from a broker or an agent, they all follow the same rules. So you shouldn't be surprised that they all ask you for the same things. They may ask you for less things that will be according to their own underwriting process, but across the board, they will ask for the same things. Once you already have purchased the policy itself, definitely it is recommended that you store the policy in your home, somewhere where your survivors can easily find it. Make sure that you have a conversation with the next person, your spouse, your father, your sister, whoever the beneficiaries are. They should know where they can easily locate this information, and then also store another copy outside of your home. Let's say, God forbid, there's a fire in your home and that's the only copy. I will keep that copy, like in a safe deposit box, anywhere else where, it could be protected from fire or theft. And then make both copies. Let your beneficiaries know where both of these copies are, so that they know where to look. So this brings me to the end of our topic for today. We truly appreciate your time in visiting us today for our topic of the week. We hope that you found value in today's message. And if you have any questions for us in general, please do reach out to us at your convenience. And as always, we wish you a great night, and we will see you next